Welcome back to Financial Market Insights for Traders, where we break down complex financial concepts and help you make informed investment decisions. I'm your host, Sophia, and today we're tackling one of the most fascinating and dangerous phenomena in financial markets, market bubbles. If you've been watching the markets over the years, you've probably heard of asset bubbles, sudden price surges, and dramatic crashes. But what causes these booms and busts? How can you recognize a bubble before it bursts? And more importantly, how can you protect yourself from financial disaster? By the end of today's episode, you'll have a deeper understanding of market bubbles, historical examples, and strategies to safeguard your investments. Whether you're a long-term investor or a short-term trader, knowing how to navigate speculative markets can save you from massive losses. So let's dive in. What is a market bubble? A market bubble occurs when the price of an asset rises rapidly to unsustainable levels, far beyond its intrinsic value. This surge in price is often driven by investor excitement, speculation, and excessive liquidity rather than solid fundamentals. Market bubbles typically follow a five-phase pattern. Displacement, a new economic development, innovation, or policy shift generates excitement. Boom! More investors jump in, driving prices higher. Euphoria, speculative frenzy takes over and prices skyrocket. Profit-taking, experienced investors start selling, cashing in on the gains. Panic and crash, prices plummet as the bubble bursts, leading to financial losses. This cycle repeats itself throughout history in different asset classes, from stocks and real estate to cryptocurrencies and commodities. What causes market bubbles? Several factors contribute to the formation of a market bubble. Speculation and FOMO, fear of missing out. Investors rush in hoping to make quick profits without considering fundamental valuations. The herd mentality causes prices to inflate beyond reasonable levels. Excessive liquidity and low interest rates. Central banks often cut interest rates or inject liquidity into markets, making borrowing cheap. Investors take on excessive risk, inflating asset prices. Technological innovations and hype. Groundbreaking advancements, like the internet boom in the late 90s, fuel investor enthusiasm. While some innovations prove valuable, many lead to unrealistic expectations. Leverage and margin trading. Borrowing money to invest can amplify returns, but also magnify losses. When the bubble bursts, margin calls force investors to sell, accelerating the downturn. Psychological factors, greed, and overconfidence. People believe that this time is different, ignoring historical patterns. Emotional decision-making replaces rational investing. Famous market bubbles in history. Let's look at some of the most notorious bubbles and their lessons. 1. The Dutch tulip mania, 1637. The first recorded market bubble. Tulip bulb prices surged to extreme levels before collapsing. Some bulbs were worth more than houses before prices crashed. 2. The South Sea Bubble, 1720. Investors poured money into the South Sea Company, expecting immense profits. When reality set in, the stock crashed, causing widespread financial ruin. 3. The dot-com bubble, late 1990s, early 2000s. The internet boom led to excessive speculation in tech stocks. Many unprofitable companies saw stock prices soar before the bubble burst. Companies like Amazon survived, while others vanished. 4. The 2008 housing bubble. Cheap credit and excessive speculation led to a real estate bubble. Subprime mortgage defaults triggered a global financial crisis. Governments bailed out banks, and markets took years to recover. 5. The cryptocurrency boom and bust, 2017-2021. Bitcoin surged to nearly $69,000 in 2021 before crashing. Speculation and hype fueled the rally, while regulations and market corrections led to declines. How to identify and avoid market bubbles? As an investor, spotting a bubble before it bursts can save you from devastating losses. Here's how you can protect yourself. 1. Pay attention to valuations. Compare stock prices to key metrics like price to earnings, PE ratios. If prices are absurdly high with no earnings growth, a bubble might be forming. 2. Monitor investor sentiment. When everyone is convinced an asset can only go up, it's time to be cautious. Extreme optimism often signals a peak. 3. Watch out for excessive leverage. High margin debt levels usually indicate increased speculation. If traders are borrowing excessively to invest, a crash could be near. 4. Diversify your portfolio. Avoid putting all your capital into one asset or market. A well-diversified portfolio can reduce the impact of a market downturn. 5. Set stop-loss orders and take profits. If you trade CFDs, always use stop-loss and take-profit strategies. Protect your gains and limit potential losses. How CFDs can help you navigate market bubbles. CFD trading allows you to profit in both rising and falling markets, making it a strategic tool for trading in volatile times. Here's how CFDs can be beneficial. Short selling, profit from falling prices when a bubble bursts. Leverage, trade larger positions with less capital but use it cautiously. Hedging, use CFDs to hedge against potential losses in your portfolio. If you're looking for a reliable platform to trade CFDs on stocks, Forex, and cryptocurrencies, crystalballmarkets.com offers excellent trading conditions and risk management tools to help you stay ahead in volatile markets. Final thoughts. Market bubbles are a recurring phenomenon, driven by speculation, easy credit, and investor psychology. While they can create incredible profit opportunities, they also pose significant risks. Understanding the boom and bust cycle, recognizing warning signs, and using proper risk management strategies can help you navigate speculative markets effectively. Whether you're trading stocks, real estate, or cryptocurrencies, staying informed and disciplined is the best defense against financial loss. If you're interested in trading CFDs in volatile markets, check out crystalballmarkets.com for expert tools and insights to make informed decisions. That's it for today's episode of Financial Market Insights for Traders. Stay smart, trade wisely, and keep an eye on the fundamentals.